In the autumn of 1929, as stock prices collapsed and panic spread across trading floors, a simple explanation quickly took hold. Wall Street, driven by greed and speculation, had gambled recklessly and brought the global economy down with it. Newspapers printed images of ruined investors, politicians denounced bankers, and the stock market crash became the defining symbol of the Great Depression. Over time, this explanation hardened into something close to historical fact. Ask almost anyone why the Great Depression happened, and the answer usually begins and ends with the excesses of Wall Street. But when we step back and examine the broader picture, uncomfortable questions emerge. If the crash alone caused the depression, why did economic conditions already show signs of weakness years before 1929? Why did countries with little exposure to Wall Street still experience devastating downturns? And why did the depression last so long, far beyond what a market crash would normally produce? These questions suggest that the story may be far more complex than the familiar narrative allows. In this video, we're going to examine this story in detail and uncover what history usually leaves out. To understand whether Wall Street truly caused the Great Depression, it is necessary to look beyond the dramatic events of October 1929 and examine the economic structure of the 1920s as a whole. The decade is often remembered as the Roaring Twenties, a period of prosperity, technological innovation, and rising consumer culture in the United States. Industrial output increased, automobiles became common, and mass production transformed daily life. But beneath this surface of growth, the economy was deeply uneven. Wealth was concentrated at the top, with a small percentage of Americans controlling a large share of income and assets. Wages for many workers failed to keep pace with productivity, meaning that consumption increasingly relied on credit rather than real purchasing power. This imbalance created a fragile economic system, one that appeared strong as long as confidence held, but lacked resilience when conditions changed. The stock market boom of the 1920s reflected this fragility rather than creating it from nothing. Millions of Americans were drawn into the market, often buying shares on margin, which meant borrowing most of the purchase price from brokers. As long as stock prices continued to rise, this system seemed to reward everyone involved. But it also meant that even a modest decline in prices could trigger forced selling, amplifying losses across the market. Wall Street did encourage this behavior, and financial institutions profited from it, but speculation was not confined to professional financiers. It became a cultural phenomenon, fueled by widespread optimism and the belief that modern capitalism had eliminated the old cycles of boom and bust. This belief, shared by investors, economists, and policymakers alike, played a critical role in setting the stage for collapse. When the market finally broke in late October 1929, the consequences were immediate and dramatic. Share values plummeted, paper wealth evaporated, and confidence was shattered. Yet it is important to recognize what the crash did and did not do. The crash destroyed financial assets, but it did not directly destroy factories, farms, or the skills of workers. In previous financial panics, markets had collapsed and then recovered within months or a few years. What made the Great Depression different was not simply the crash itself, but the chain reaction that followed. Bank failures, collapsing credit, falling demand, and rising unemployment turned a financial crisis into a prolonged economic catastrophe. This raises an important question. Were these outcomes inevitable consequences of Wall Street's actions, or were they shaped by deeper structural weaknesses and policy decisions? One of the most significant factors often overlooked in popular explanations is the role of the banking system. In the late 1920s, the United States had thousands of small, poorly regulated banks, many of which were highly vulnerable to economic shocks. When stock prices fell and businesses struggled, these banks faced waves of withdrawals from frightened depositors. Without federal deposit insurance, a single rumor could trigger a bank run. As banks collapsed, they took with them the savings of ordinary Americans and sharply reduced the availability of credit. Businesses that might have survived a temporary downturn found themselves unable to borrow, forcing layoffs and closures. This process transformed a market correction into a systemic crisis. While Wall Street investment banks were part of the financial system, many of the bank failures that devastated local economies had little direct connection to stock speculation. At the same time, the agricultural sector was already in crisis well before 1929. American farmers had expanded production during World War I to meet European demand, often taking on significant debt in the process. When the war ended and global demand fell, crop prices collapsed. Throughout the 1920s, rural America experienced something resembling a depression of its own. Farm incomes declined, loans went unpaid, and banks in agricultural regions were under constant strain. This ongoing crisis weakened the national economy and made it more vulnerable to a major shock. By the time the stock market crashed, large parts of the country were already economically fragile, challenging the idea that Wall Street alone triggered the downturn. International factors further complicate the picture. The global economy of the 1920s was shaped by unresolved tensions from World War I. European nations struggled with war debts and reparations, while the United States emerged as the world's leading creditor. International trade was constrained by tariffs and protectionist policies, limiting global growth. When the American economy slowed, the effects were transmitted worldwide through financial and trade networks. Countries with limited exposure to Wall Street, including those with small stock markets, still experienced severe economic contractions. This suggests that the Depression was not merely an American financial crisis exported abroad, but a global breakdown rooted in structural imbalances across the international system. Monetary policy also played a critical role in turning the crash into a depression. The Federal Reserve, still a relatively young institution, faced the challenge of responding to a rapidly deteriorating economy. Instead of aggressively expanding the money supply to counter deflation and bank failures, the Fed allowed credit to tighten. Interest rates remained relatively high, and the money supply contracted sharply as banks collapsed. Some economists argue that this policy response, driven by a desire to maintain the gold standard and fear of inflation, significantly worsened the downturn. From this perspective, Wall Street's collapse was the spark, but monetary policy decisions poured fuel on the fire. This interpretation does not absolve Wall Street of responsibility, but it does place its actions within a broader context. Financial speculation amplified existing weaknesses, but it did not create them in isolation. The economy of the 1920s was built on fragile foundations: unequal wealth distribution, excessive reliance on credit, a vulnerable banking system, struggling agriculture, and a rigid international monetary order. The stock market crash exposed these weaknesses, but the severity and duration of the Great Depression were shaped by how institutions and governments responded to that exposure. As we continue examining this question, it becomes increasingly clear that focusing solely on Wall Street risks oversimplifying a far more complex historical event. The crash was dramatic and visible, making it an easy symbol of failure and greed, yet symbols can obscure as much as they reveal. To understand whether the Great Depression was truly caused by Wall Street, we must follow the crisis beyond the trading floor and into the deeper structures of the economy, the decisions of policymakers, and the global system in which the United States was embedded. To move beyond the crash itself, we need to examine how the American economy reacted in the months and years after 1929. This is where the Wall Street explanation begins to break down most clearly. A stock market collapse by itself does not automatically lead to mass unemployment, years of deflation, or a near total breakdown of industrial production. Those outcomes depend on what happens next, on how credit flows, how governments respond, and how confidence is either restored or destroyed. In the early 1930s, nearly every major response taken by institutions deepened the crisis rather than containing it. One of the most damaging developments was the collapse of the banking system. Between 1930 and 1933, thousands of American banks failed. These were not primarily large Wall Street investment houses, but small, local banks that served farmers, shopkeepers, and small manufacturers. When these banks closed, depositors lost their savings overnight. This had an immediate psychological impact. Fear spread quickly, and even healthy banks faced runs as people rushed to withdraw cash before it disappeared. Each failure triggered the next, creating a self-reinforcing cycle of panic. As banks vanished, so did credit. Businesses that depended on short-term loans to meet payroll or purchase inventory suddenly found themselves cut off. Even firms that were fundamentally sound were forced to shut down, not because of Wall Street speculation, but because money itself stopped circulating. Deflation made this situation far worse. Prices began to fall across the economy, which might sound beneficial to consumers at first glance, but in reality, it was devastating. As prices fell, debts became heavier in real terms. Farmers, homeowners, and businesses found that the money they owed was worth more than the money they earned. This discouraged spending and investment, since holding cash became safer than using it. Deflation also encouraged layoffs, as employers struggled to maintain profits while prices dropped. Again, these dynamics were not the direct result of stock trading practices. They were systemic failures rooted in monetary contraction and the absence of stabilizing mechanisms. The Federal Reserve's role during this period remains one of the most debated aspects of the Great Depression. Created in 1913 to prevent exactly this kind of financial collapse, the Fed failed to act decisively. Rather than flooding the economy with liquidity to stabilize banks and credit markets, it allowed the money supply to shrink dramatically. Part of this reluctance stemmed from adherence to the gold standard. Under this system, the value of the dollar was tied to gold reserves, limiting the Fed's ability to expand credit freely. Policymakers feared that aggressive intervention would undermine confidence in the currency or trigger inflation. In hindsight, this caution proved disastrous. By prioritizing the stability of the financial system as it was imagined to exist, the Fed allowed the real economy to disintegrate. Fiscal policy compounded these mistakes. Instead of increasing government spending to offset the collapse in private demand, the federal government initially moved in the opposite direction. President Herbert Hoover, often unfairly caricatured as completely inactive, did take some steps to address the crisis, but his core belief in balanced budgets and voluntary cooperation between businesses limited his response. Taxes were raised in 1932 in an effort to close budget deficits, draining even more money from an already contracting economy. This decision, while fiscally orthodox at the time, deepened unemployment and reduced consumer spending further. Once again, these outcomes cannot be explained solely by the actions of Wall Street. They reflect a broader failure of economic thinking and policy. International developments also played a critical role during this phase of the Depression. As the American economy contracted, it reduced imports, hurting export-dependent economies around the world. In response, many countries adopted protectionist measures of their own. The most famous of these was the Smoot-Hawley tariff of 1930, which raised U.S. tariffs to historically high levels. Intended to protect American industries, it instead provoked retaliatory tariffs and caused global trade to collapse. World trade fell by more than half in just a few years. This collapse intensified the depression worldwide and fed back into the American economy by reducing demand for U.S. goods. Wall Street did not design these trade policies, yet their impact was central to the depth and duration of the crisis. Another overlooked factor is the structure of American industry itself. By the late 1920s, many industries had expanded capacity far beyond what sustainable demand could support. This overproduction was especially evident in sectors like automobiles, steel, and consumer appliances. As sales slowed, inventories piled up, forcing companies to cut production and lay off workers. These layoffs reduced income and demand further, creating a downward spiral. The problem was not that Wall Street caused factories to produce too much, but that the economic system lacked mechanisms to balance production with purchasing power. Once the system tipped, recovery became extremely difficult. Social and political responses to the Depression further shaped its trajectory. As unemployment soared and hardship spread, public trust in institutions eroded. This loss of confidence discouraged investment and reinforced the tendency to hoard cash. In some countries, economic collapse fueled radical political movements, destabilizing governments and increasing uncertainty. While the United States avoided the most extreme outcomes seen elsewhere, fear of unrest influenced policy decisions and delayed reforms. The longer the Depression persisted, the harder it became to reverse, as temporary shocks hardened into permanent damage. When Franklin D. Roosevelt took office in 1933, the narrative surrounding the Depression shifted. Wall Street was publicly blamed, and financial elites were portrayed as villains whose excesses had ruined the nation. This framing was politically effective and not entirely unjustified. Financial speculation had played a role in destabilizing the economy, and reforms were clearly needed. But the focus on Wall Street also served another purpose. It simplified a complex crisis into a moral story of greed and punishment. This made it easier to mobilize public support for reform, but it also obscured the deeper structural and policy failures that had allowed the crisis to escalate. The New Deal introduced reforms that addressed many of these underlying issues. Banking regulation, deposit insurance, public works programs, and social safety nets all helped stabilize the economy and restore confidence. Notably, many of these measures had little to do with curbing stock market speculation directly. Instead, they focused on strengthening institutions, supporting demand, and reducing vulnerability to future shocks. This suggests that policymakers themselves recognized that the Depression was not merely a consequence of Wall Street behavior, but a systemic failure requiring comprehensive solutions. As we continue this examination, a clearer picture begins to emerge. Wall Street did act irresponsibly in the 1920s, and the crash of 1929 was a critical turning point. But the transformation of that crash into the Great Depression was driven by a cascade of failures: monetary, fiscal, institutional, and international. By focusing too narrowly on Wall Street, we risk misunderstanding not only the past, but the lessons it holds for managing economic crises in the future. In the next part, we'll explore how global economic structures and ideological assumptions locked the world into a prolonged downturn, and why recovery proved so elusive despite the scale of human suffering. To understand why the Great Depression became a global catastrophe rather than a short-lived downturn, we need to widen the lens beyond the United States and beyond finance itself. By the early 1930s, the world economy was tightly interconnected in ways that magnified shocks rather than absorbing them. The foundations of this system had been laid not on Wall Street, but in the aftermath of the First World War, through debt arrangements, currency regimes, and political assumptions that left little room for flexibility when crisis struck. Europe entered the post-war period economically exhausted. Entire regions had been physically destroyed, productive capacity had been diverted toward war, and millions of workers had been lost. To rebuild, European governments borrowed heavily, much of it from American lenders. At the same time, the United States emerged from the war as the world's dominant creditor and industrial power. This imbalance created a fragile triangular system. American banks lent money to Germany. Germany used those funds to pay reparations to Britain and Britain and France used those payments to service their war debts to the United States. On paper, the system functioned. In reality, it depended entirely on continued American lending and uninterrupted economic growth. When the American economy slowed after 1929, this flow of capital reversed. U.S. banks recalled loans, desperate to shore up their own balance sheets. Germany, suddenly deprived of credit, faced banking collapse and soaring unemployment. Britain and France, no longer receiving reparations, struggled to meet their obligations. What followed was not simply a financial contraction, but a political crisis, as governments faced pressure to prioritize domestic survival over international cooperation. This unraveling of the global financial system did not originate on Wall Street, though Wall Street was deeply entangled in it. Its roots lay in the aftermath of the First World War, through debt arrangements, currency regimes, and political assumptions that left little room for flexibility when crisis struck. Central to this fragility was the gold standard. By the late 1920s, most major economies had returned to it, believing that stable exchange rates and disciplined monetary policy would restore confidence. In practice, the gold standard imposed rigid constraints at precisely the moment flexibility was needed most. Countries experiencing economic contraction could not easily devalue their currencies or expand their money supply without risking gold outflows. Instead, they were forced to cut wages, reduce spending, and raise interest rates to defend their gold reserves. These policies deepened unemployment and deflation, turning recessions into depressions. Britain's experience illustrates this dynamic clearly. In 1931, facing a balance of payments crisis, Britain abandoned the gold standard. Conventional wisdom at the time viewed this as a sign of weakness, yet the British economy began to recover relatively quickly afterward. Freed from gold constraints, policymakers could lower interest rates and support domestic demand. By contrast, countries that clung to gold the longest, including the United States and France, suffered deeper and more prolonged downturns. This raises an important question. If Wall Street speculation were the primary cause of the Depression, why did recovery depend so heavily on monetary regimes and international coordination rather than financial reform alone? Ideology played a powerful role in shaping responses to the crisis. Economic orthodoxy in the early 1930s emphasized austerity, balanced budgets, and market self-correction. These ideas were deeply ingrained among policymakers, central bankers, and economists across the political spectrum. Government intervention was viewed as dangerous, potentially undermining confidence and encouraging irresponsibility. As a result, many leaders hesitated to take bold action even as unemployment soared and production collapsed. This was not a conspiracy or a coordinated refusal to act, but a shared belief system that limited the range of acceptable responses. The social consequences of these choices were profound. Unemployment in the United States reached nearly 25%, while in Germany it climbed even higher. Families lost homes, savings, and dignity. Malnutrition and homelessness became widespread, even in industrialized nations. These human costs were not caused by the stock market crash itself, but by the prolonged economic paralysis that followed. Skills eroded, infrastructure decayed, and trust in institutions weakened. Political instability followed economic collapse. In Germany, the Depression undermined faith in democratic institutions and fueled support for radical movements. While it would be simplistic to draw a direct line from Wall Street to the rise of Nazism, the economic devastation of the early 1930s created conditions in which radical solutions gained appeal. Elsewhere, governments fell, currencies collapsed, and international cooperation disintegrated. The Depression thus reshaped global politics, setting the stage for future conflict. These outcomes suggest that the crisis was not merely financial, but systemic, affecting every layer of society. Within the United States, debates over responsibility intensified. Business leaders often blamed labor unrest and declining profits, while labor organizations pointed to wage cuts and job losses. Farmers blamed banks and railroads, while urban workers blamed industrial monopolies. Wall Street remained a convenient symbol, but it was far from the only target. Congressional investigations into banking practices revealed real abuses, including conflicts of interest and excessive risk-taking. These findings justified regulatory reform, but they did not fully explain why the economy had collapsed so completely or why recovery was so slow. The Roosevelt administration's evolving approach reflects this growing understanding. Early New Deal policies experimented with a wide range of ideas, some successful, others less so. What mattered most was not any single program, but the shift in mindset. Government began to see itself as responsible for stabilizing demand, supporting employment, and managing systemic risk. Leaving the gold standard, expanding public spending, and creating social insurance marked a decisive break with earlier assumptions. These changes addressed vulnerabilities that had existed long before 1929 and would have remained even if the stock market had never crashed. At the same time, it is important not to swing too far in the opposite direction. Wall Street speculation did matter. The crash destroyed wealth, confidence, and credit, accelerating the downturn. Financial elites wielded enormous influence and often resisted reforms that threatened their interests. The culture of speculation in the 1920s reflected deeper imbalances in income distribution and corporate power. But treating Wall Street as the sole or even primary cause of the Great Depression risks obscuring the broader mechanisms that turned a financial shock into a decade-long catastrophe. As this narrative continues, the focus shifts from causes to consequences and lessons. The Depression forced societies to rethink the relationship between markets and governments, between national sovereignty and global integration. It exposed the dangers of rigid systems in a volatile world and the costs of ideological inflexibility in the face of human suffering. In the final part, we'll bring these threads together, returning to the central question of whether the Great Depression can truly be explained by Wall Street alone, or whether that explanation has endured because it is simpler, more moral, and easier to remember than the more uncomfortable reality. By the mid-1930s, the Great Depression had already reshaped economies, governments, and assumptions about how modern societies function. Yet even as recovery slowly began in some places, the deeper debate over responsibility never truly settled. Wall Street remained at the center of popular memory, but policy discussions increasingly revealed that the crisis had exposed weaknesses far beyond financial markets. What emerged was a realization that modern industrial economies were vulnerable not just to speculative excess, but to structural imbalances that had been quietly accumulating for decades. One of the most important of these imbalances was income distribution. In the years leading up to 1929, productivity in the United States rose sharply, but wages did not keep pace. A growing share of national income flowed toward corporate profits in wealthy households, while ordinary workers relied increasingly on credit to maintain consumption. This imbalance created an economy that appeared prosperous on the surface but was fundamentally fragile. When credit tightened and confidence collapsed, consumer demand fell dramatically. Factories could produce goods, but fewer people could afford to buy them. This problem did not begin with the stock market crash, nor could it be solved by regulating Wall Street alone. Corporate behavior also played a role in deepening the downturn. As profits declined, many companies responded by cutting wages and laying off workers in an effort to preserve balance sheets. From an individual firm's perspective, these decisions were rational. From a system-wide perspective, they were disastrous. Each layoff reduced demand further, worsening conditions for other firms. This collective action problem highlighted a key limitation of market self-regulation during periods of crises. Without coordination or intervention, rational decisions at the micro level produced catastrophic outcomes at the macro level. This insight would later become central to modern economic thinking, but in the early 1930s, it was still deeply contested. Agriculture offers another window into the Depression's complexity. Long before 1929, American farmers were already in crisis. After World War I, global demand for agricultural products fell, prices collapsed, and farmers struggled under heavy debt. Mechanization increased productivity, but also reduced labor needs, displacing rural workers. When the broader economy collapsed, rural areas were hit especially hard. Dust storms and environmental degradation compounded economic misery, turning financial hardship into a humanitarian disaster. These developments had little to do with Wall Street speculation, yet they were integral to the Depression's severity and persistence. The federal government's expanding role during this period reflected a growing recognition that traditional explanations were insufficient. Programs aimed at stabilizing farm prices, supporting labor rights, and regulating industry acknowledged that the crisis was not confined to finance. Even banking reforms, often framed as punishment for Wall Street excess, were primarily designed to restore confidence and functionality to the credit system. Deposit insurance, for example, did not target speculators but protected ordinary savers, preventing the panic-driven bank runs that had crippled the economy earlier. Internationally, the lessons of the Depression were slowly absorbed as well. Countries that abandoned austerity and embraced coordinated economic management recovered more quickly than those that clung to orthodoxy. This pattern challenged the idea that economic suffering was a necessary corrective to past excesses. Instead, it suggested that policy choices could either amplify or mitigate crises. The persistence of the Depression thus owed much to decisions made after 1939, not just to the events that triggered it. Public memory, however, tends to favor clear villains and simple stories. Wall Street provided both. The image of reckless financiers gambling with other people's money resonated deeply, especially among those who had lost jobs, homes, and savings. Congressional hearings and media coverage reinforced this narrative, giving the public a tangible target for anger and reform. While these critiques were not unfounded, they also served to obscure less visible forces, such as monetary policy failures, international rigidity, and structural inequality. By the mid-1930s, the Great Depression had already reshaped economies, governments, and assumptions about how modern societies function. Yet even as recovery slowly began in some places, the deeper debate over responsibility never truly settled. Wall Street remained at the center of popular memory, but policy discussions increasingly revealed that the crisis had exposed weaknesses far beyond financial markets. What emerged was a realization that modern industrial economies were vulnerable not just to speculative excess, but to structural imbalances that had been quietly accumulating for decades. One of the most important of these imbalances was income distribution. In the years leading up to 1929, productivity in the United States rose sharply, but wages did not keep pace. A growing share of national income flowed toward corporate profits and wealthy households, while ordinary workers relied increasingly on credit to maintain consumption. This imbalance created an economy that appeared prosperous on the surface, but was fundamentally fragile. When credit tightened and confidence collapsed, consumer demand fell dramatically. Factories could produce goods, but fewer people could afford to buy them. This problem did not begin with the stock market crash, nor could it be solved by regulating Wall Street alone. Corporate behavior also played a role in deepening the downturn. As profits declined, many companies responded by cutting wages and laying off workers in an effort to preserve balance sheets. From an individual firm's perspective, these decisions were rational. From a system-wide perspective, they were disastrous. Each layoff reduced demand further, worsening conditions for other firms. This collective action problem highlighted a key limitation of market self-regulation during periods of crises. Without coordination or intervention, rational decisions at the micro level produced catastrophic outcomes at the macro level. This insight would later become central to modern economic thinking, but in the early 1930s, it was still deeply contested. Agriculture offers another window into the Depression's complexity. Long before 1929, American farmers were already in crisis. After World War I, global demand for agricultural products fell, prices collapsed, and farmers struggled under heavy debt. Mechanization increased productivity, but also reduced labor needs, displacing rural workers. This simplification had lasting consequences. By framing the Depression primarily as a morality tale about greed, societies risked overlooking systemic vulnerabilities that could reappear in different forms. Financial regulation improved, but debates over income inequality, global imbalances, and the role of government remained unresolved. In later decades, these unresolved issues would resurface during new crises, often accompanied by familiar arguments about responsibility and blame. As the Depression faded into history, economists and policymakers continued to debate its causes. Some emphasized the crash and financial panic, others pointed to monetary contraction, and still others highlighted structural and international factors. What is striking is that no single explanation fully accounts for the scale and duration of the crisis. Each captures part of the truth, but none stands alone. This complexity challenges the enduring belief that Wall Street, by itself, caused the Great Depression. As we approach the conclusion of this story, the central question remains unresolved but clearer. Wall Street mattered, but it operated within a system shaped by policy choices, global constraints, and social realities. The Depression was not inevitable, nor was it the result of a single failure. It was the product of interconnected decisions made over time, many of them well-intentioned, others deeply flawed. In the final part, we'll bring these strands together and return to the question that has shaped public understanding for nearly a century: whether blaming Wall Street tells us more about our need for simple explanations than about the true nature of economic collapse. As we reach the end of this examination, it becomes possible to step back and reconsider the Great Depression not as a single dramatic failure, but as a convergence of vulnerabilities that had been building quietly for years. The stock market crash of 1929 remains a powerful symbol, in part because it provides a clear moment when optimism turned to fear. Yet symbols can mislead. When the crash is treated as the cause rather than the trigger, it narrows our understanding of how modern economies actually break down. Wall Street did not exist in isolation. It reflected the priorities, incentives, and assumptions of the broader society in which it operated. Speculation flourished in the 1920s because credit was cheap, regulation was limited, and faith in perpetual growth was widespread. These conditions were encouraged not just by financiers, but by policymakers, business leaders, and a public eager to participate in prosperity. When the system collapsed, it revealed not only excess, but a lack of safeguards capable of absorbing shock. What transformed a financial panic into a decade-long depression was the response, or lack of one. The failure to stabilize banks, the contraction of the money supply, and the insistence on defending the gold standard all turned a downturn into a disaster. These decisions were shaped by prevailing economic ideas that prioritized discipline over resilience. They were not the result of malice, but of deeply held beliefs about how economies should function. This distinction matters because it shifts the lesson from moral judgment to institutional design. The international dimension further complicates the story. Global debt structures, rigid exchange rates, and retaliatory trade policies transmitted distress across borders. No single country controlled these dynamics, yet all were affected by them. The Depression exposed the dangers of economic interdependence without coordination, a lesson that would later influence the creation of international institutions after World War II. Once again, these developments lie far beyond the trading floors of New York. Even recovery, when it came, did not arrive all at once or through a single policy. It emerged through experimentation, adaptation, and a gradual rejection of earlier assumptions. The New Deal did not end the Depression on its own, but it altered the relationship between the state and the economy in lasting ways. By acknowledging that markets could fail on a systemic level, it laid the groundwork for more active economic management. This shift suggests that the true legacy of the Depression lies not in condemning speculation, but in recognizing the limits of uncoordinated systems. Returning to the opening question, was the Great Depression truly caused by Wall Street? The answer resists simplicity. Wall Street played a role, sometimes reckless, sometimes influential, and often symbolic, but focusing exclusively on financial markets obscures the deeper forces that turned vulnerability into collapse. Monetary rigidity, policy hesitation, global imbalance, and structural inequality all shaped the outcome. Each interacted with the others, creating a crisis no single reform could easily resolve. This perspective does not absolve financial actors of responsibility, nor does it dismiss the real suffering caused by speculative excess. Instead, it broadens the lens, inviting us to see the Depression as a warning about how complex systems fail. When institutions are brittle, when ideology limits response, and when inequality undermines demand, shocks become catastrophes. These patterns are not confined to the past. Nearly a century later, the Great Depression still occupies a central place in public memory, often reduced to a story of greed and collapse. But history, when examined closely, rarely conforms to such clean narratives. The enduring value of this period lies in its complexity. It challenges us to ask not only who was at fault, but how systems can be designed to endure uncertainty and change. In the end, the question is not whether Wall Street caused the Great Depression, but why that explanation has remained so compelling. Perhaps it endures because it offers clarity in the face of chaos and blame in the face of suffering. Yet the deeper lesson is more unsettling, that prosperity can coexist with fragility, and that collapse often reveals weaknesses we preferred not to see. Understanding that may be the most important history leaves us with.